How have unit trusts performed in the first quarter of this year? Johan Gouws, head of ABSA Asset Consulting, joins me now for some more insight into this. Good to have you with us as always, Johan. Just the overview from your perspective of the Q1 performance of unit trusts. Are they there?
It's actually been very good again. I think unit trust investors generally can feel very happy. There's obviously some winners and some losers, but I think generally most of your unit trust investors would actually feel quite satisfied. If you look at what's happened in the first quarter, very much a similar story as what has happened over the past year, with really your real estate sector of the unit trust funds coming through very strongly. We had the average real estate unit trust fund giving you a return of 11.7% in the first quarter.
Sure.
And that's on the back of pretty much the same kind of number at the end of the last quarter in 2014. And then on the equity side, your average equity fund manager would have given you a return of about 4%, and your average multi-asset class fund around about 3.4%. But if you just go back 1 year from the 31st of March, then you'll see that the average return from the real estate funds have been 40%, whereas an average equity fund would have given you a return of 8%, which is like 5 times what an average equity fund would have then given you, while the multi-asset class has given you a 10% return. So really, it has been all about the real estate sector.
Relative to the benchmark of these unit trust performance, I take it then they are shooting the lights out, the 3 sectors that you mentioned in particular?
Yes, well, if you look at the best returning fund in the real estate sector has given you a return of 44.8% relative to the average fund of 39%, so there isn't such a big gap there. And I think it's partially as a result of the fact that that sector is so highly concentrated with 2 of the stocks in that sector that really represents about half of the index. If you look at the equity funds, again, quite a dispersion in terms of the returns. Your worst performing fund over the quarter has given you basically a return of minus 6%, while the best performing fund would have given you a return of 12%. And I think that comes back to the whole issue about how the different sectors have performed, because again, it has been the financials that's performed well. That sector gave you around about a 10% return in the first quarter, where the resources sector has given you a minus 2% return. And that was really just came through from the last quarter of last year as well, where we know that the strong dollar, lower oil prices, that has really caused major problems for the resources sector, where the financial sector has really gained, from the better prospects when you look at inflation and then also the interest rate outlook.
I know you don't have a glass ball to look into to predict the future, but one wonders if the current environment is sustainable for resources to continue being such a drag when it comes to performance and financials. We know with the ongoing talks, the US Fed, our own economic fundamentals here in South Africa. Could all of these change?
Absolutely. I think there's a lot of asset managers that's starting to get concerned about where do they place the additional money that they're taking into their funds, because some of these valuations in the financial and industrial sectors are really starting to become, quite steep. And I think, therefore, we'll see that most probably some opportunities in the resources sector will be identified. When that will actually, those opportunities will be unlocked is difficult to say, because we're still sitting with the labor issues in that sector. We're still sitting with slow economic growth. We're still sitting with a strong dollar that's keeping commodity prices down. So that might be a longer term investment, but I think at current valuations, it's starting to be quite compelling. And I think also then that's also one of the reasons for why your managers will still continue to have a lot of the exposure offshore as much as possible, given the fact that there's less opportunities in the South African market from a valuation perspective, and where some of the opportunities in the global markets are still looking quite attractive.
On the topic of the offshore split, what's the average there?
Well, really, a lot of the money is really sitting in your Regulation 28 type of funds. So all I can say about that is that the Regulation 28 really limits you to about 25% maximum exposure to offshore assets. And what I can tell you is that most of these asset managers are really sitting close to that 25% maximum limit in your more medium, high equity type of multi-asset class funds.
Speaking about multi-asset management funds, how did they perform in this last quarter?
Again, there's quite a difference in terms of the best and worst performer. So you had your 9% best returning fund there, and you had your worst returning fund giving you a return of minus 3.6%. So that is more about your asset allocation calls that you get right or wrong. So obviously, the fund that's given you the 9.3% return would have most probably have gotten the real estate bet right, and most probably would also have gained from some of the offshore exposure, specifically also related to the rand depreciation with the stronger dollar, really.
On asset allocation, I take it cash hasn't really generated much in return?
Cash, again, I think just over the past year have barely given you any real returns, so very much in line with inflation, around about 5.5%, 5.7% for most of the funds. So that has not been an option really for somebody that really wants to grow their money in real terms.
Johan, maybe if we touch on your expectations then for the next quarter and even from a yearly perspective, is 2015 expected to be a very bullish year for unit trust performance versus what we've seen in the past?
I think my concern is that we might have seen the best of the year already in the first quarter. That is really my concern right now. I think a year ago we wouldn't have expected the kind of returns we did see at that point in time. Now it's a year later and we again have seen really, really good returns. So I would say that I think investors generally will have to basically tone down their expectations when it comes to the returns on the unit trust. It doesn't mean there ain't opportunities out there, but the asset managers are really going to have their work cut out to try and identify those opportunities, capitalize on them, and that is why I believe that investors should look at your multi-asset class funds, where professional asset managers are really on a day-to-day basis looking at the market and making those decisions on your behalf.
And because of the nature of unit trusts, I take it then they should ignore the noise, the daily noise of news headlines and erratic share price movements.
Absolutely. A unit trust is a well-diversified type of investment. It's a well-regulated investment. There's full transparency in terms of fees. So it's still, in my mind, for the majority of people, remains the investment vehicle of choice. And all you have to basically get right is your asset manager that can really get it right most of the time. Your asset manager will not get it right every time, but at least most of the time.
Johan, thank you so much for your time today. Interesting insights there on some of the performers from a unit trust perspective. Good having you as always. That was Johan Gouws, who's from ABSA.